Welcome to the Realizations Podcast. I'm Andrea Gordon, your host, and I'm excited to explore the world of real estate with you. In a world where perceptions often overshadow reality, Realizations seeks to redefine what it means to be a realtor. Join me as we peel back the layers of the industry, uncovering inspiring stories and celebrating the good in real estate. Whether you're a homeowner, a fellow realtor, or simply curious, this podcast is for you. Welcome to Realizations, where perceptions meet reality. Let's dive right in. Welcome, everyone. My guest today is Natalie Salins. She is an independent mortgage broker, and we're going to talk a little bit about her background, what she does, why it's important, and how realtors and mortgage brokers intersect. So welcome to the program, Natalie.
Hi, thank you. Nice to meet you officially, and I'm excited to be here.
Excellent. So give us a little bit of information about you. I know you've been in the business for like 20 years, but what did you do before that? How did you get into the business? What's important to you about being a mortgage broker?
I've always loved numbers. I've always been very quick and fast with them. And I have a friend who was doing mortgages, and I watched what they did, and I was like, I can do, like, I think I can be really good at that. I'm a problem solver. That's really all that it is problem solving and putting out fires and good communication. That's really the name of the game. And so I got into it and have enjoyed it and kind of thrived in it ever since. Yeah.
Okay, so, and you are an independent mortgage broker. Explain to us what that is. What's the difference between being an independent mortgage broker and a not independent mortgage broker?
Sure. So I work for an IMB, which is an independent mortgage bank.
Yes.
So it is an institution that only does mortgages. That's all we do. So we do everything. We run the gamut of basically every type of program, every type of product, VA, FHA, renovation, non-QM, which encompasses asset depletion loans and bank statement only loans and all the things that are not standard, government regulated. Plus we broker out, plus we correspond, we fund our own loans, we service our own loans. We kind of do the gamut of mortgages.
Is it a portfolio lender then?
No, we aren't. So we do all of it. So we have some things that we service and keep in-house and our portfolio, but then we broker out quite a bit. Almost all of our jumbos are through bigger banks that we delegate and correspond, which means we underwrite them in-house, we will fund them in-house, but we do send them along to the Chase or the Citibank that we are underwriting them for.
Correct.
Based on credentials and things like that. But most of those jumbos are like that, but also the broker loans. We broker quite a bit out to different credit unions when there's like an interesting guideline that we need to fit or whatever. So that's really the difference. An IMB is all encompassing of mortgage. We do all of it, as opposed to like a direct depository bank.
Right.
Or your big lender banks, which they have their own set of guidelines and overlays. And they're a little bit more strict. They don't run the gamut of all different types of guidelines and stuff. And then you have your proprietary lenders like a credit union, and then hard money lenders and so on and so forth. But I've been working in a mortgage bank for probably around 16 years in different IMBs. And they're, for me, it's the way to go because I get to offer anything. You can come to me no matter what your situation, and we're going to find a place for it.
Very cool. Yeah, I come from a background of being a teacher and also working in theater. And so a lot of my early clients were people that were independent contractors, were working in circuses, were musicians and things like that. And so it was always very, very hard for me 27 years ago when I started out to find lenders who could make it possible for my friends and clients to get a home. So I'm really interested to hear this. So you're a source for unusual people that don't fit other people's cookie cutters, projects that don't fit other people's cookie cutters. Do you,
Correct.
do you do
Yeah.
any fractional lending on tenants in common buildings, those
TICs.
kinds of things?
That's one of the things that it's very, very specific to that certain bank that allows for it. So there's really
Right,
only a couple in the country that do
right,
TICs. And it's because
right,
they want to own the entire building. It's one APN.
right,
And due to it being one APN, if there is a problem in one of the units, you have to truly consult with everybody else because everybody owns the building.
right.
Different than a co-op like in New York. This is it's a little bit because even co-ops you have your own APN. This is really truly
And when
shared
she says
living.
APN, by the way, she's talking about assessor's parcel number, which means that in terms of the world of taxation, et cetera, everybody thinks of it as one place, even though there might be 4 or 5 units in the building. Is that about right?
Exactly. That's
Yeah,
exactly right. And
yeah,
so multiple lenders don't want to own that property together. And you really get stuck with only being able to finance through this one bank who owns the property. And so
got it.
they will do financing on each individual unit because they basically own the property as a whole. And
Correct.
that's why TICs are difficult to finance and they stay very specific to that bank.
Right, right.
Yeah.
And do you do lending on new planned urban developments and things like that?
Absolutely. All
Okay,
day long. And movement is amazing with like new construction builds and condo rehabs and all of that. Like we're pretty good with our builder department.
and movement is the name of your current
Yeah.
IMB.
Yes,
Okay,
sorry.
and no, that's fine, Natalie.
Movement mortgage.
Where
Mhm.
where are you based out of?
Los Angeles.
Okay, and do you do loans all across the state, all across the country? What areas are you licensed in?
I am licensed only in California, but
Mm-hmm,
Movement is a nationwide lender.
mm-hmm.
And I have people on my team that are basically licensed all over the country in every state.
Right. And, mortgage regulations change per every state, just like the contract for the realtors changes every single state. The way real estate is practiced changes even in the state of California. In Northern California, we as agents handle all of the paperwork. In Southern California, the title company, the escrow officer, basically handles all of the transactional paperwork. So there are very different ways that real estate is practiced in literally every state of the union. And it also, city by city, there are different regulations and requirements and all of that. So as realtors, we have to know all that stuff.
We'll research
And
it when it comes up, because
yeah,
even from one county to the next, loan limits change. From one
yep.
zip code to the next, different programs are available. So, yeah.
And different banks have different requirements relating to insurance, for example, which is a big problem right now, especially in the state of California with all of our fire issues. And I am sure in places like Florida, they're having the same sorts of issues in relationship to their bad storm weather conditions that can destroy everything.
Yeah.
So all of these complications come in, and you have to have somebody on the other side, either your lender or your realtor, or both, I should say, who understand the ramifications of all of this stuff. It's crucial because if they don't, you can have a big problem come up where you don't qualify, or you have a liability if you're a seller relating to disclosure, or if you're a buyer, you might buy a pig in a poke if someone isn't smart and looking out after your best interests. So that's a large part of this podcast. I'm trying to educate you guys as to why it's important to have somebody who's actually knowledgeable, capable, experienced on the other side of a transaction. And there are so many different lives that real estate touches. For example, Natalie in lending. She is there to provide service to her clients and advice. How often do you come upon people who don't qualify for a loan, and do you give them advice on how to address those issues?
Um, it's not too often because we kind of get creative to try to work it out no matter what.
Mhm.
But there are times when simply the credit is too low, then there's really nothing we can do about it. If it's under
Right.
580, there isn't
Mhm.
anyone who will buy it. FHA will allow for 580 and above. But under 580, we set them on a plan to get the credit up. And then we check back in when the credit is up and we can look at what options are available at that point for them. The
Mhm.
other times that we kind of just have to say no is if they just started a new business and they're self-employed.
Right.
If they were W-2, which means taxes are taken out of their pay stubs and I go off the gross, and they decide to leave that job to start their own consultant business or their own self-employed business, where now they're 1099 and they don't earn monies that are taxed, it's too hard for us to know what their average income will be after
Mhm.
tax. And of course, we have to go off tax.
So how many years does someone have to work in their new entrepreneurial position before you will be able to consider them for a loan?
Normally, it's 1 year.
Okay.
So
And
a lot of people will think it's two, but it's not. It's normally one, or it's until I can see the income on a tax return and how
right.
it's written off. But if it's 2 months of income on a tax return, it's not going to be enough to qualify.
Mhm.
Um, if it's 8 months, it might be enough to get us to where we need to be, and then we can see how to qualify them that way.
Got it.
Um, yeah.
Got it. Yeah, and I've had commodities traders who are dealing in unbelievable sums of money who did not qualify because their income was so variable for, and by the way, I will tell you this, every single person out there wants something that is literally $200,000 more than they can afford. It follows whatever the price point is, $200,000 is the differential. Wouldn't you say I'm about right?
I mean, for sure, for self-employed, you'll find that people who are just straight W-2 borrowers,
Mhm.
because it's much more stable and specific what they're making, they a lot of the times don't want to kick their ratios too high because they know exactly what they make every pay stub, and
Right,
they're much more conservative because we qualify off the gross,
right,
and they're not
right,
getting that. They're getting
right,
their net. So for
right.
them, when you're just a straight standard salaried employee, most of the time they set their own guidelines and limitations and they're like, that's it. That's all I want. But
And yeah. Mhm.
everyone self-employed wants to get qualified for hire, but that's because they make more. They just don't show it.
Correct. And I've also had people that deducted so much off of their income based on their business expenses that they literally did not qualify, even though their gross was huge. Um, and
Gross was huge, but the net is, I know. And with
right,
clients like that, we just quickly shift them into bank statement only. So if
right.
I can see that the gross is large, I'm like, this is a bank statement only loan. So we don't have to go off the tax returns. We go off the actual income that's earned into the bank statements.
Very cool. Very
Yeah.
cool. And you also have worked in renovation loans, and you discussed with me prior to our talk here that you work in home style loans. Can you explain what those are to us, please?
Yeah. So there's two different types of standard renovation loans, and most people will go to the 203K. Most people, when they see a renovation loan, that's their first thought.
And can you explain what that is for everybody?
Of course. So 203K is through FHA. So it's an FHA renovation. And so FHA is a government regulated insurance company, and they offer loans with very low down payment for very low FICO, for zero money in a bank. They really offer a very high risk level loan. You of course pay mortgage insurance for it, but it's great for first time home buyers, or primary homeowners, um, and they offer a renovation program. They have two different kinds. They have a streamlined renovation, which is up to 35,000. It's really just for cosmetics.
Mhm.
Anything above that, anything that is structural, anything that requires permits, that's going to kick you into a K loan, a 203K, which is a consultant loan, which means it's there's more detail to it, and it's a larger project for the buyers. So that's the renovation with FHA. You're going to have mortgage insurance. You can put much less money down. And it's a little more costly. Fannie and Freddie came up with their own renovation program called HomeStyle. And with HomeStyle, you can put as little as 5% down. Then you have options at 10% down, 15% down, 20% down. They will allow renovation loans for investors, where of
Wow.
course FHA will not. It's always only primary borrower. But
Mhm.
HomeStyle allows for second homes, like a vacation home, and for investors. So as long as you have 25% down, you can do HomeStyle. An investor can buy a property and get the renovation he needs financed.
So my own experience with FHA 203K loans is that they will send someone out to look at a lot of the health and safety items relating to the property. And those will have to be handled in an FHA 203K loan, along with some of the other renovations that you want to do. And they will do an after renovation appraisal
Yes.
to come up with the valuation for the property, based on, if you fix the whole front porch that's rotted, or you do a complete gut remodel on the kitchen. They will come up with a value, and they will loan up to 80%, is it? Or I don't remember the
On
FHA 203K.
96.5.
96.5%, because it's FHA, forgot about that. They'll loan up to that new value, as opposed to what the property would actually be worth if somebody were evaluating it on an appraisal and in its current condition, which is what a normal loan does. A normal loan looks at the house, warts and all, figures out the value at that exact as is condition. So that's the big difference between an FHA 203K and a normal loan. Now with HomeStyle, is it the same?
HomeStyle is the same. It's ARV. You go on the after renovation value, and HomeStyle's it's they're actually back to back. They're kind of the same program.
Mm-hmm.
It's just who you sell it to, but it's basically the same program. The funds are held in the same type of account in the same department. It's our 203K department. Funds are held and distributed to the contractor in the same way with the same underwriters and everybody. Just there's more allowable in the HomeStyle, plus there's not as many fees in the HomeStyle. It doesn't cost as much. You don't have the upfront mortgage insurance that's added to the loan. You don't have the mortgage insurance that's a higher monthly percentage as well. You go off Fannie mortgage insurance.
And let's say an investor gets one of these HomeStyle loans. How long are they required to hold that loan before they flip it?
There's no prepayment penalty. If they finish the renovation fast, they can sell it and flip it, or they can refi, get into a better loan and take over and live it. They can do whatever they want. Yeah.
When I did the 203K loans that I've done, the buyer has already known what the loan they're going to get at the end of the 203K loan is and what the interest rate will be.
Absolutely. Yeah.
Is that standard practice on the HomeStyle as well?
It is. Yeah. If you're doing a purchase, because you can do renovation refinances, so it means you're already in the home, you don't have money or equity to do the renovations, you can get into one of these renovation refis. But if you're doing it as a purchase, and let's say you have 60 days, which is kind of what we like, because contractors can be fickle and we don't quite get everything we need quickly.
Right.
I like to say 45 to 60. If the contractor is great, I can do 30 to 45, but you never know. I've had contractors back out and there's 10 days left of escrow and we need an entire new contractor to come in and take over the bids and, everything.
Right.
But because they aren't
We
the
all have-
reliable people.
They are fickle. It's true.
They're contractors. So, and we need them on this loan. So it is contingent upon the contractor, these files. But
Right.
you get in, if we want to lock early, I lock on a 45-day lock or a 60-day lock. That's your rate. We know the loan only based on the bids. So if you're purchasing 800,000 with a 200,000 renovation, we basically go off $1 million as your purchase. You bring in the down payment you planned on based on
Right.
$1 million. So if you were going to do 5% down, you're bringing in 5% down from $1 million.
Got it.
The appraisal has to come in at least at $1 million, of
Mhm.
course, because we
Yeah.
can't give money and leave the property underwater.
Right.
So it has to be knowing that what the after renovation value is
Mhm.
at $1 million, and then we give you a loan for $950. And it's kind of that simple. And then we give 200,000 according to what kind of renovation and the bid,
Right.
what work is needing to be done. We distribute to the contractor or to yourself in chunks.
Does the bank end up being almost the one who is divvying out that money to the
It is.
contractor?
Yeah, we hold it. And we're the ones who kind of handle all the renovation funds and
So you
fees.
stay completely involved from start to finish.
It is. It's a process. Yes. And if it's very lengthy, like there's a lot of work to be done, then we have to send new appraisers out because we have to make sure, we have to inspect it to make sure it's going along as planned. Like, are you getting the permits needed?
Right,
Did you
right,
build
right,
those walls that you said you were going to? Did you rip up the floor? Did you, like if it's extensive,
right. And the other thing that happens in construction all the time is you open up a wall and you find something gross that you have to deal with. And
yes,
so those numbers change. Is there flexibility at all in this loan in relationship to the work that gets done?
there is, we do a reserve. They hold a reserve for either up to 10 to 15%, depending on the work.
Wow.
And
Okay.
that can be a pain because it's monies you can't necessarily count on to be paid out to you, but I have to still include in the loan and in the renovation.
Right, right.
So you lose
What
that
did-
money at first. It's yours. If you don't use it, it goes back to you,
Mhm.
but you don't get to use it necessarily towards the bids.
I hear you loud and clear. Do you have some sort of a handout that you give to people when they're getting these kinds of loans?
I do. Yeah, of
Because
course.
it's extremely complicated.
It
Um,
can be. I have
and
contractor packages and everything. Yeah.
that's very cool. That's very, very
Yeah.
cool.
Yeah. I mean, they're amazing. The thing is like, what you can do and accomplish with these loans is incredible. I had people last year purchasing and building ADUs and us giving them renovation towards ADU money. And when they did it, I was like, this is going to get tricky because it's only going to value based on ADU comps.
Right. And that is tricky. That's
And
very
that's really tricky, you guys. Do we have enough in the area
right.
to bring up the value 250 grand? Like, but
Right.
it came in valued like way over like 100 grand over once the ADU was built. Like it's amazing. Like, it's really, the problem is LA and permits, and
Well,
the renovation department likes to be finished after 6 months. And at 4.5 months, they had just got their permits.
yeah, no, I live in Berkeley, which is probably
Oh,
worse
yeah.
than Los Angeles, I would guess, because here everybody has a political stake in everything everyone does on everything. There's
Totally.
NIMBYism is huge. By the way, when we mention ADUs, we're talking about accessory dwelling units, which is very popular right now. It's a great way for somebody to stash their older mom and dad, or to have
Income.
student rental income or some such. So that is a very, very popular thing that people who have enough land and can meet the requirements, which are ample and also change per municipality. That's a great way for people to augment their income. And that's a very smart use of this kind of a loan.
It is. It's amazing.
I'm so interested that I talked to you about this today, Natalie. This has been really, really, really interesting. So just because I ask this of every mortgage broker that I talk to, what is your prognosis for interest rates and change? I love the expression. She's like, damn you.
Oh boy. Well, especially with the past month, right? Like the
Yeah.
past month has been gruesome on
Yeah.
interest rates. Like
Yeah.
4 weeks ago, I was at 6.1 and
Right.
5.99. I was in the high fives, low sixes, refinancing people out of their 8% from last
Right.
year. And like,
Right.
and now we're in the high sixes, unless
Yes.
you put a lot of money down and stuff. So, that's too fast to come up this much, in my opinion.
Mhm.
And I've been in this a while, so I know exactly how much my buyers can handle in the cushion of,
Mhm.
I quoted you, it's going to be 4,000 and now it's 5
Right.
in just the matter of a month.
Right.
So, it's a bit extreme right now. And I've been expecting it to kind of shift back down because it's too much almost. And mortgage-backed securities, we just got information this morning that Like they might have to start pumping money into them to keep them selling the way they did during COVID, because people have backed off buying them too much.
Well,
Because
people have backed off buying, period, actually. I mean,
I know.
buyers are not out there right now because they're freaked out about the interest rates, the election.
Which are so much lower now, actually. Last year we were a full percent higher, right? So there is positivity that can be spread in this. And I'm going to give you a very good story after, even with all this positive economic news that's happening right now, pretty sure it has to do with the election and also the fact that we're heading into holiday season.
Yep.
A lot of jobs, part-time jobs, that's what they forget to mention, but part-time jobs being hired, and there's always consumer confidence and spending that goes on. It's the holidays, but starting into next year, I do believe that the numbers will shift back to normalcy and that the Fed will come back to their word of lowering, and that we will continue to see a lowering next year. And not just one lowering next year, which they did this year. I mean, who knows? They said they were going to lower this year a few times, and they only did it once.
They were supposed to do it in November, by the way.
I don't think they're not gonna, based on all this economic news. I
Right.
really don't think so. I think it'll be a Hail Mary if they do.
Right.
They said they were gonna do it twice in
Oh,
September.
I
They
know.
said
And
they-
the first time when they said that they were going to do it, it was very, very punishing to the real estate industry, because when they didn't hold to their word, buyers got pissed off and they took their marbles and went home, and as well they should have.
Of course.
So
So with that said, if you should wait or not till this happens, the answer is really no. We've done a lot of market research on this. I have a flyer called The Cost of Waiting.
yep.
It does not serve you to wait, actually. So my buyers
You can refi for free, can't you?
basically, yes. I mean, a couple thousand that you can put into the loan, or you can put it into the rate, or there's always ways to do no cost refi.
Right.
But, so I call my buyers that stuck with it last year when rates were in the high 7s and low 8s, my strong-hearted buyers. They are thrilled right now that they bought when they did. So it's been a year. I locked a bunch of people, 7.8, 8, 8.1 even on duplex. Runs the gamut on like how high those interest rates were. They paid 1 year higher on this higher interest rate. I got them into 6.5, 6.2, 6.1, some of my clients. They're now saving $800 a month, $1,000 a month, right? We did appraisals, and nearly all the values, even in this slow market, came up 10% or more.
Right.
So I have a client who bought last year at $1 million. They put 20% down. They got 7.8. They put 200,000 and their loan is 800,000. The value came in at 115.
Right.
115.
Right.
So now if they tried to buy the exact same house just 12 months later, it's 150,000 higher. Their down payment would have had to have gone up by 30 grand. So they would have been out 30 extra thousand just for the down payment. Now their mortgage is 160 or 70,000 higher. So now their payment overall is just way higher than the 12,000 extra they paid in mortgage for the higher interest rate for the 1 year.
Correct.
So there's only 12,000 extra for the higher interest rate for the year. We got them into something lower. Now it's 12,000 lower. Their mortgage is way lower. Their down payment and out of pocket was way lower. Everything is better, and everybody is thrilled. Like everyone that got in.
Big win. That's a big win.
It's a big win. And it's 1 year later. And everybody that I've talked to is like, oh my God, we're so happy we're not buying right now.
Yeah.
You know?
And you know what? I will also tell you briefly, when I was a little kid, we moved from Berkeley to New York City. And we sold our big, beautiful house right in the Berkeley Hills with a Golden Gate Bridge view for $67,000. I remember a woman coming up to my mother at our going away party going, "Oh my goodness, you are so lucky. No one will ever see these prices again." And she was very, very right, because that same house traded hands last year for 3.2 million.
Yeah.
That's the thing. real estate's, if you look at a graph, it's going to be jiggling up and down and going, higher, lower, higher, lower, higher, lower. But at the end of the day, if you have a strong heart and are not terribly risk averse, the reality is if you hold on to a house for more than 2.5 or 3 years, you're going to do very, very well. So now is a great time to buy, actually, because there are a lot of people that are dropping prices. I just heard today in a legal seminar meeting that we had that over 40% of houses in the United States have done a price reduction in the recent past. Was that because they were priced too high to begin with? No, it's because they're trying to entice buyers to come back to them. So now is a golden opportunity for you as buyers to buy something. You should be out looking right now. If you get a high interest rate,
100%, especially with where rates are, because if you can stomach the payment, the temporary payment, they say for every 1% in interest rate, higher or lower, like 15 million people back out of the market.
Right.
So if and when interest rates come down next year, guess how many more people are coming back into the market, right? So now you're facing all of that competition, bidding higher, having to spend more on the property, all of that comes back into play, which is not fun for buyers either. I think it's a give and a take, but getting in when you can is the most important.
Well, Natalie, you are absolutely wonderful. I am so happy to have gotten to know you today.
Yes.
If buyers want to find you, can you give us all of your contact information, please?
Of course. Do you want me to put it in the chat box or just send it to you?
Just you can send it to me, but also please say it.
Just say it. Okay. So my email is just my name, Natalie.Salins. It's SALINS at movement.com. It's the name of the company, movement.com. And my phone number is 917-992-9134.
Awesome. Thank you so much for being my guest today. I think people learned a lot.
Ah, great.
I learned something, so I'm going to be in touch.
I love it. Yeah, absolutely. Such a pleasure.
All right. Take good care. Bye-bye.
Thank you. Bye.
Thank you for joining me on this episode of the Realizations Podcast. I hope our conversation has shed light on the true essence of real estate and the people behind it. As we wrap up, I want to extend my gratitude to our listeners for their support and engagement. Your feedback drives the heart of this podcast, and I look forward to continuing this journey with you. If you enjoyed today's episode, please consider subscribing to the Realizations Podcast and leaving a review. Your support helps us reach more listeners and spread our message of positivity in the real estate industry. Until next time, remember to keep an open mind, embrace empathy, and always seek the good in every situation. I'm Andrea Gordon, signing off from Realizations. See you next time.